Adobe stock is down big today. The Nasdaq's up, but it's currently down 8.75%. Pre-market, it was down over 10%. Now, guys, why is that? Well, it's pretty interesting. Adobe announced EPS and revenue that both beat market expectations. Both of them beat. You might be wondering, well, then why the hell is the stock down? Well, before we get into why the stock is down, this is their actual quarterly results. Record Q3 net digital media ARR. I believe ARR is annual recurring revenue of $504 million, with exiting RPO surpassing $18 billion, which is a record. Exiting RPO is the revenue that they project out for the future. So they have a record $18 billion. Anything bad there so far? Not yet. Adobe's Q3 performance is a testament to our relentless innovation, blah, 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 blah. Q3, Adobe delivered cash flows over $2 billion and exited the quarter with a record RPO. $2 billion in cash flow. Okay, let's see what they did in the same quarter last year. So we're going to go to our quarterly. So the same quarter would have been August of last year. Last year they had 1.87 minus 91 million, so call it 1.78 billion versus 2 billion. So they increased their revenue by their cash flow by 11%. Anything you want to cry about so far? Neither do I. Okay. Achieved revenue of 5.41 in its third quarter of 2024, represented 11% year-over-year growth. EPS per share, 376 on GAAP and 465 on non-GAAP. Cash flows were 2.02 billion. Adobe repurchased approximately 5.2 million shares during the quarter. Now, granted, this is their earnings result. But why are they down? Well, guys, this is why they're down. Yes, they beat analyst revenue and EPS expectations. Its gross margin also improved. So every extra unit they're selling, they're making more money on it. However, the market was likely expecting more. The stock market overreacts to news. I love they said that. And here's what it was. After the company reported its revenue guidance for next quarter missed Wall Street estimates. In addition, remaining performance obligations, RPO, came in slightly below consensus, suggesting that Adobe may face increased pressure to meet its near-term growth. Free cash flow came in below expectations. So 11% increase in free cash flow, but below expectations. Guys, if you're new to what we're doing here, this is our 24/7 channel, and I love talking about the news and earnings releases. And the main reason is, though, I want to use it to teach. This record, all these records they're having, they beat on earnings, they beat on revenue, and people are punishing them by 10% of the market cap of the company because they guided less. Did they guide less in the sense of astronomically less, 10% less? No. That's what's interesting. This is what I say when I say news follows a stock price, and the emotions of the market are just a voting machine. There's no way that 10% drop is rational if they were worth what they were worth. They were worth 10% more yesterday. But to have a 10% drop because they guided poorly, guided less than expected for the next quarter. Guys, the next quarter? You can't call yourself a long-term investor if you're worried about next quarter. Question, is Adobe a good company? Answer, yes. Question, does Adobe have a good balance sheet? Answer, let's go check it out. So let's go look at Adobe from a 500-foot view. Guys, $241 billion market cap, $248 billion enterprise value. That difference is essentially their net debt of $7 billion. They generated $6.37 billion in free cash flow in the last 12 months. They generated $2 billion last quarter. They could pay off all their net debt with 3 quarters in less than 1 year with 3 quarters of our cash flow. As if it didn't get better, high and increasing ROIC. So it means they're becoming a better and bigger moat, and they get a really good return on the money that's invested in the business. 88% gross margin. These are freaking these are train locomotive kind of margins with a bottom line of 25 to 30%. And their free cash flow last year and the last 5 years is significantly higher than last year's net income and their last 5 years net income. Oh boy, this is what I want you to do. I want you to remember this. Next time a stock you love is falling, but yet the numbers still look good, but it's based on guidance. Take that as an opportunity potentially. Now the guidance could be the start of something major that's bad. I get that. But if the stock went up 10% because guidance was better, I mean, do you want to overpay because of one quarter with the good guidance? Give me a break. So this makes sense to you guys. And if you want to hear more about, with 4 or 5 videos a week about the markets, about economy, about these individual companies, subscribe to the channel. This is what I love talking about. I came into the office today. I came in the office today. Our studio wasn't open. I had Nick come down. I said, Nick, I want to do a video on Adobe because I think it's a great learning experience. A freaking top quality business. One of the 33 companies I want to own in my portfolio that I would like to own someday at the right price. But yet it's being beaten up. Why? Because they guided poorly. Guys, would I be shocked if Adobe wasn't around in 10 years? Absolutely. They make a top quality product, high margin, increasing returns on invested capital, and then as a company balance sheet. But remember, there's a difference between the company and the stock. We got to differentiate those. And when you're able to differentiate those, you're able to make a decision based on investing. I've talked about this countless times. For example, I have a Cybertruck. I like that car a lot. And guess what? I'm not touching Tesla's stock price because liking the car and the company versus liking the stock, totally different things. I want you to understand that nonstop. This is such an important aspect to investing. We have a company, all-time high of $700 back in 2021, got as low as $275 or so back in September of 2022 after that bear market in tech stocks. Went back up, came back down, was going back up. I mean, this volatility is insane. Had a low price of $433 just on May 31st. The volatility on this company is insane. But that can be your friend when you understand that when you buy a stock, you're buying a piece of a business. Now, let's go see what analysts are saying about this company. First, let's go to the 8 pillars very quickly. Everything to check except for the 5-year PE, 5-year price to free cash flow. 38 times free cash flow in the last 5 years seems a little pricey. I don't care. I mean, unless you're going to grow a ton, that seems tough. So what do analysts expect for their growth? EPS growth, 14%, 13%, 15%, 12%, 12%. $18.50 to $30 in the next 5 years. And they're going to generate more cash flow than that. Revenue growth, double digits. I'm actually surprised that the profit growth isn't 20 or 30% with these kind of revenue growth numbers because of how high their gross margin is. When you have a company with a really high gross margin, every extra unit they sell, big chunk of that goes to the bottom line, right? Before taxes. Because you've already covered your overhead costs. That's huge. So if you're seeing 10% growth, I would expect at 6 or 7% of the earnings per share. That's incredible. Easily. But it's not doing that. Maybe they have to put more money back in the business. I have no idea. But I look at this as a top quality company. And on our main channel, I've evaluated the company more deeply. So if you loved Adobe at $700 per share, one question for you. Why would you not love it today? Why would you not love it at 400? Why would you not love it at 300? Because eventually when there is a bear market and that bear market occurs, the high-flying NASDAQ stocks with the high valuations will probably be hurt the hardest. Mark that right here. Make sure you write that down. Paul said it on this date at this time because you'll see that. It's happened in 2022 and it's happened out throughout history. The most overhyped companies fall the hardest. And Adobe is a company that you're going to want to pay attention to because as it falls harder and harder, you're going to want to pick up more shares if you think the company's financials are getting better. Thank you for your time.